So we've had tough talk today from the White House on tariffs, saying that the U.S. administration is determined to slap on that massive extra levy on imports from China, bringing the total import duty burden to more than 100%. Our guest says, sure, this may well stoke inflation, but the U.S. economy could dodge a recession. We are joined now by Andy Brenner, head of international fixed income at Natalliance Securities. Andrew, hard to know where to begin here. Just on the Trump's aggressive talk on Chinese tariffs, you're a critic. You say it's hard to expect Beijing to negotiate under these terms.
I think he's making it very difficult on China. I think he's made it much more difficult than it has to be as far as negotiations go. Obviously, we saw as yesterday morning, at one point, the S&P was down 22.5% from its high, and the NASDAQ 27.5%. It seemed to me, based on yesterday's trading, that was a capitulation day. Call it Manic Monday or Black Monday or whatever. And today was Turnaround Tuesday until the Chinese announcement came out. But we think that the worst is still behind us, but it doesn't mean it's not going to be ugly going forward. We can't have this kind of uncertainty with all the tariff situations being talked about, so on and so forth. We need to get this thing behind us so we can get the U.S. economy back together again.
A lot of senior figures on Wall Street calling on President Trump to resolve this thing. Is there any, will that pressure prompt the administration to really reach deals on these tariffs?
I think in certain instances with Japan, I think with Korea, I believe it's going to be a one-on-one. My view I really wanted to talk about interest rates in the Fed, but my view is that he should have given much more time for this to be negotiated before it goes into effect. And I think you would have gotten better results without as much volatility. I don't think it's necessary. And you really, put the economy at risk. And I don't think that was his original intention. And when I look at what Elon Musk who's a fellow Wharton guy like myself, is saying about Peter Navarro and so on and so forth, you can tell that we're not the only ones that think that this tariff situation is a little bit out of whack and should be, and the rhetoric should be brought down. But that is not going to happen in the near term.
Peter Navarro, the legendary trade hawk and advisor to President Trump. There's no reining him in, it seems, at this stage. Talk to us about interest rates. Your feeling is that the Fed this year will cut 3 times?
My feeling is the Fed will cut 3 times. Yesterday morning, you're out to 5.2 times based on the market expectation. And today, you were down to the low 3s, but now you're back above 4 again. And what is going on is I've seen some of the most massive steepening of the yield curve. 230s was out when I last looked, 17 basis points today. 230s, just to give you an idea, has gone from a level of 50 basis points, meaning the 30-year was 50 basis points higher in yield than the 2-year, to now 105 basis points. Wow. This is only in the last few days. This is some of the biggest moves we've ever seen and some of the steepest curves we've seen probably in about 12 years. The other thing that's going on is swap spreads are just soaring. They're tightening versus 30 years. So what it's implying to me is with basis trades being taken off and yield curve trades being taken off, there really is a problem with the long end of the Treasury market. And I think this will force the Fed to get somewhat involved and, much more quickly than we would have thought before. So we're actually thinking the Fed's going to have to ease in May. And as I looked, it was about 55-45 in favor of May. And that would mean that there'd have to be a lousy unemployment number. We saw the latest JP Morgan employment scenarios, and they're looking for the unemployment, which is 4.1 or 4.2 right now, to go out to 5.3 by the end of this year. So that's a big whopping number, and I think that's going to force the Fed to get involved, even though they prefer to hold and wait and until they see a better idea of what inflation does. I don't think the Fed can wait. I think the Fed's got to gear up And Powell's speech last week did not look like he was ready to do that. But you start showing some very weak employment numbers, and you start talking about the idea of potential recession, and I think Powell will come to the rescue. I believe the Fed put is alive and well.
When we say behind the curve, sometimes that means that the Fed has been too slow to cut, or that it's relying on outdated information. I think your concern is more the latter.
Well, I think that both things are going on. I think that the Fed is looking at what they call hard data, which is the last unemployment number, which is very much backward looking. And they're not looking at the surveys, the JOLTS numbers, the numbers that show how the economy is slowing, how the sensitivity of the economy is going weaker. And I believe that they're going to find that the employment numbers in the future are going to look pretty ugly. And when they do, it will be too late. They should be easing now, or they should be getting ready to ease in May. And I know that there's at least a half dozen Fed governors that would actually say, hey, you don't know what you're talking about. Inflation's a real problem. Well, you know what? We do have stagflation. There's no way around it. I agree that the tariffs are not going to be transitory, like Powell originally said, and then somewhat brought that back. But I believe that at the end of the day, it's much more important to get the employment situation right and help towards that end than it is to worry about the blips of inflation right now.
But will lower interest rates even help when tariffs and the disruption are the problem? Oh, I'm sorry, Andrew. We might have to leave that till next time because I think we're out of time. Give us a very quick thought. I mean, can lower interest rates help? And I'm sorry, we're so tight for time.
Yeah, I think lower interest rates would show that the Fed is concerned, the Fed put is real. I think it would go a lot to stabilize the markets. And I also think the Fed has to get more involved in actually buying treasuries because there isn't a demand for the 30-year, and we have to auction a lot of 30 years on Thursday.
Thank you, Andrew. Thank you very much. Andrew Brenner, the closing bells are up next.
Thank you.